Ian, you and I have been working together, and Oaktree's been working with the Power Group for 20 years now. You came to us in 1996. Can you tell us about that, and can you tell us what the Power Group does?
Sure. We met with you and your colleagues and looked for capital to invest in the businesses that serve the utility and the power sector.
I think it's important to make a distinction between serve the sector and be the sector.
Correct. At the time, we were very reluctant to take commodity risk. We knew we couldn't predict commodity prices. And so we felt if we could find the businesses that provide the picks and shovels to the miners, rather than becoming a miner ourselves, right, that would fit our own risk tolerance, which was very, very low.
Right. Now, I like the way you've worked the word risk into your first answer, because obviously one of the reasons that your group and Oaktree came together so neatly was the high emphasis you put on risk.
Yes.
Back in '96, we put together a chart specifically with regard to the many kinds of risk that are faced and that you either would not take or would restrict very strongly. Can you tell us about that?
Yeah, in addition to all the usual risks that one would anticipate, there were 6 risks that we said we wouldn't take as it related to our industry. The first one I already mentioned, which is commodity risk. We also weren't looking for turnarounds. We were looking for successful businesses that have leading market positions. We also weren't looking for technology risk. There's lots of businesses in our sector that are clean tech, green tech. They have very high mortality rates. We also knew we wouldn't look for investments where the returns were predicated on extending the financial leverage of a business. We also wouldn't look for investments that depended on public policy for them to make sense. They had to make sense on their own. And then finally, we had a risk that we called it inertia risk. Yes. Because the utilities tend to move pretty slowly, they have sometimes relatively perverse economic incentives. We learned the hard way that we didn't want to find businesses that depended on utilities moving aggressively or quickly to adopt new technologies.
Right. What has always made me feel best is that the list of risks and the attitude toward risk has never changed.
Correct.
And I think that's great. You know, a lot of people, as they're more successful, tend to think that they can be more cavalier about risk because obviously they've proved that they're the smartest people in the world. And so far I haven't detected that from your group.
No, to the contrary, I think you wrote a memo some time ago about luck. Mm. And we've been very, very lucky, and at some point our luck may run out, so we better be careful, and we begin extra cautious. We've always taken the responsibility of managing other people's money very, very seriously, right, never wanting to lose any money is the primary goal.
Right, right. Now, when you came to Oaktree in '96, you came to a company which has a motto, if we avoid the losers, the winners take care of themselves.
Right.
It sounds sufficient when you're talking about fixed income. But when you're aspiring for high equity type returns, as you do, it strikes me that's not enough. It's not enough to avoid the losers. You have to actually find some winners. So how do you deal with that motto in your context?
I think it falls into 2 categories. There's the way we assess risk. There's what does risk mean to us when you're buying a controlling interest in a business. And the second is how do we make decisions about the investments that we're making. With respect to the first category, what does risk mean to us? We're always looking for asymmetric risk. We definitely believe in the motto that you laid out, and that translates into the price we're willing to pay. We always want to make sure there's enough cushion in the prices that we have. But I think fundamentally it comes down to really understanding the businesses and understanding the management teams, which is something that we can do in the control side that maybe fixed income is a lot more difficult to do. And then the second part of it is how we make decisions within our group. We build a culture in which we build to consensus. We actively encourage dissenting opinions, and if we don't have a consensus, we won't make the investment. We also work hard with our management teams of our portfolio companies. In fact, we foster an environment in which bad news travels quickly, which we think is very important. But we also bring them into the diligence, and because we're interacting with these managers on an ongoing basis, they have no incentive to hype their forecasts or hide liabilities that we may not otherwise find.
I'm positively impressed by your insistence on consensus. And I think it's a good example of risk control. If you require consensus from a group of intelligent, able people, it means that there are investments you won't make. If you're a risk controller, you feel better about the investments you make. If you're an aggressive investor, you might feel badly about some of the ones you miss.
True.
But when you insist on consensus, it's because you're willing to miss a few in order to increase the batting average. And I think that's great. The other thing I want to go back to is you used the word asymmetrical. I think it's a very powerful word. When I think about Oaktree and its goals, I think about asymmetry. And basically, to put it into plain terms, the surprises are on the upside.
Right.
And I think that that is really the essence of risk control, isn't it? That you have thought enough and been selective enough to weed out the surprises on the downside. And if you weed out the losers, then the positive surprises really take care of themselves. Now, 20 years now, we're working together in an area where there is substantial technological content and a lot of stress, given that the power system is flawed and in many ways inadequate. So what's changing in your world vis-a-vis risk?
There's lots of change, and by the way, we love them. Technology is changing, regulations are changing, environmental standards are changing. As an example, there are times in California today where wholesale power prices are negative. It's like negative interest rates. It doesn't make any sense for very long. But there are producers of power who are actually paying for the right to put their power into the grid. If you don't understand how these things work, you're not going to make money as an investor. Easy credit is a thing of the past with this kind of change. And so it's a much better investing environment for us.
We thrive in uncertainty.
We love uncertainty.
Confident times connote high asset prices, which is not our friend.
Exactly right. And that's exactly what we're seeing right now in the power sector.
Right.
More uncertainty, more perceived risk, and more opportunity for knowledgeable investors.
One of the big topics in 2015 and 16 has been illiquidity.
Yes.
And, with the post-crisis regulations, in particular, banks can't position securities, which has made them not the buyer of last resort, makes it hard to sell illiquid positions, especially in tough times. What's your attitude and what's your group's attitude with regard to liquidity?
Well, I think in many ways people think that increased liquidity translates into less risk. Within control strategy, I actually think that the benefits of control far outweigh the additional risk of illiquidity.
Yes.
Firstly, we can do a lot more due diligence in a control investment than anyone can, even buying a public security. We get to know the management team. We truly get to understand the business. Secondly, once we've made the investment, we control our own destiny. We help develop the strategy. We can refine the strategy. We can adjust as circumstances change in concert with management, which we couldn't in a non-control situation. We can also deal with issues when they arise. Because we're a control investor, it's much easier for us to put in additional capital if we need it. We're truly the partners. And then finally, we control our exit. I'd rather control the way we exit the investment than simply go back to the market and, if people are buying, find a price that clears the market.
Right, right. I think that, I wrote a memo about liquidity about a year ago, and I said in there that liquidity is not necessarily a good thing. Most people tend to overtrade, and if that's the case, things that restrain you from trading may add to your returns.
So do you think that liquid strategies are inherently less risky than controlled strategies?
I think that liquidity is a good thing for people who have their emotions under control. But the combination of a liquid market and emotions run rampant is what makes people buy at the highs and sell at the lows. So first of all, liquidity is not an unmitigated boon, but it is a plus for people who do the right thing.
So you're saying if your emotions are under control and you can be objective, then you're not going to be pulled along like a sheep.
Exactly.
And the sheep liquidity hurts the sheep.
Exactly. Exactly. But I think that your point, which is that control usually is accompanied by limits on liquidity. It's better to have control than to have liquidity.
I agree with that.
Everything else being equal.
I definitely agree with that. I think the benefits of control outweigh the benefits of liquidity from a risk control standpoint.
Well said. Well, Ian, this has been a great discussion, and I think it has given our viewers a real chance to understand risk control in action at Oaktree.
Thank you, Howard.